More austerity in Spain. With that and the rest of the business is Maryam.
Absolutely. Good morning, Kay. Good morning, Simon. Yes, the Spanish Prime Minister, Mariano Rajoy, has addressed Parliament this morning. He set out a new raft of austerity measures. Mr Rajoy said there would be a €3.5 billion cut in local authority budgets. He also said he would raise the value-added tax by 3 percentage points to 21% as part of a larger package of tax hikes and spending cuts aimed at trimming the public budget by €65 billion over the next 2.5 years. Well, Phil Tyson from ICAP says even after these key measures, key problems will still remain.
Yeah, they're putting a lot of pressure on him. The rise in VAT is a little embarrassing because at the back end of last year he'd kind of ruled that out, and now the pressures are coming to bear. He's having to sanction a rise in that tax, an unpopular measure. He's also going to sort of cut employment benefits, social security benefits. I think this is all sort of going to help at the margin, but the key underlying problems still remain, and that is that the progress on deficit reduction so far in Spain has been very poor. Last year's deficit came in 3% higher than expected. They've now been given an extra year to get the deficit down to 3% of GDP by 2014. But the underlying issue is that the official growth projections still look very optimistic. They're looking at a return to growth next year, growth of close to 1.5% in 2014. And if, as I suspect, growth is significantly weaker than that, then that's going to push up the profile for borrowing and increase the pressure on Spain.
That's the problem, isn't it, Phil? Not only for Spain, but for so many Eurozone economies, it's where to find the growth when you also need to find the austerity.
Exactly, and that is a big issue because they're being asked to sanction more and more austerity, which in turn sort of drives down growth and puts upward pressure on bond yields and makes sort of refinancing costs for these countries very, very difficult. Spanish 10-year yields are back at 7% now, and that scares investors. And you know, we're back at sort of the sort of level that Greece, Ireland and Portugal had to seek official sovereign bailouts. And I fear that the same thing is going to happen for Spain in the coming months if we're not careful.
The International Labour Organization is warning that unemployment in the Eurozone will rise sharply if policymakers don't take action, and the effect will ripple across the global economy. The ILO says 22 million people could be out of work, looking for work over the next 4 years, and a rise of 4.5 million. The report also says it's not just southern Europe at risk, but also stronger economies such as Germany and Austria. The ILO says there's a window of opportunity to improve things and that leaders need to focus on investing in growth and not on more austerity. Back here, following previous profits warnings from Thornton's, total sales for the 9 weeks of June actually rose 1.8 million. Action taken to revitalise its brand has started to deliver improvements in a difficult trading environment for the chocolate maker. Own store like-for-like sales during the period increased by 0.7% following the closure of 36 stores during the year. Meanwhile, the pubs chain JD Wetherspoon has reported a sharp increase in sales thanks to the Euro 2012 football tournament and the Queen's Diamond Jubilee. Like-for-like sales, which strip out the impact of sales from new and closed pubs, rose more than 6% in the 3 months to July compared with a year earlier. Total sales were up 12%. In the past year, the company has opened 40 pubs and closed 3. Let's take a look at the markets now. Not a particularly good story for the markets across Europe. The picture is a little bit negative. In terms of the London market, it's down 56.55. Brit-Vic share price down more than 14%. More business from me in an hour's time, but for now, back to you.
Thanks, Maryam.